Well, the meltdown in markets this summer has been far worse than the heat wave in India. The Nasdaq is deep into bear terrain, down 27% from highs. Even the more broader S&P 500 is reaching bear terrain, down 17% from highs. In comparison, Sensex and Nifty are down just 12%. It looks like just 12%. But Indian mid-caps are down 15% and Bank Nifty is down 18%, pretty close to bear terrain. What do you do when in trouble? You turn to the wise. And we have with us, as Ria said, Chris Wood, Head of Equity Strategy at Jefferies, decorated as the best strategist in Asia several times over by Euromoney and other magazines. His Greed and Fear is a must-read. I think the most read equities weekly in the world.
Oh, you think so?
Yes. Chris, thank you very much for coming over to the studio.
Thank you.
Okay, well, first up, I read out all those numbers, S&P 500, 17% lower. The market knows that the Fed funds rate is going to be 2.5% by the end of this year, probably 3.5% by the end of 2023. Isn't the bad news priced in? Are we anywhere close to a bottom?
No, personally, I don't think we're at the bottom because the monetary tightening cycle has just commenced, though we are clearly well underway in the correction. The interesting point about the US market is it's only in the last 3 or 4 weeks that we've begun to have redemptions out of domestic equity US ETFs. So until about 4 weeks ago, there'd been no net redemptions out of these US domestic equity ETFs. And because passive investment indexation is very popular, there's a lot of money in ETFs geared to S&P 500 Nasdaq, and so many people own the same stocks. So if we have 2 consecutive down quarters, which is entirely possible, because we had a down quarter first quarter, even another down quarter in the US second quarter, then we should anticipate more redemptions. And that's what you really need to see, big redemptions to make you think we've reached the bottom.
Okay. Well, 1 minute, Prashant.
Sure.
I take your point on redemptions. But if you look at earnings, they've not been all that bad in the ones that are just getting announced. And in the early part of a rate hiking cycle, if you compare it to 2004 to 2006, earnings actually went on doing very well. So, isn't it possible that we will still get good earnings and the market may pull back?
No, you can get good earnings, but it's an issue of the valuations. The valuations are extreme in America. I can show you a chart of price to sales in America. It was way higher at the peak than what it was in 2000, the Nasdaq peak. So it's really a function of valuation derating, not earnings collapse.
Chris, just to come back to that point in the US market, you say that this is, we're nowhere near the bottom. Where is, to your mind, we're at what, 4,000 on the S&P 500. Where do you think we hit?
Well, as I say, we're nowhere near some of the more high beta stocks have already come down a long way. So we have biotech stocks down 60% already. But before this correction is over, you would expect the big market leaders like the FANGs to have more meaningful corrections. And some have, but not all of them have. So to me, the other element of this monetary tightening cycle is not just rate hikes, it's balance sheet contraction or quantitative tightening. If I'd been talking to you last December, I would not have expected the Fed to bring quantitative tightening forward in time up the agenda. So when that news emerged in early January, that definitely made me more negative. But obviously, the valuations were way more extreme in America than even in India. India is an expensive market, but it's nothing like as expensive as America was. And also the monetary tightening here is going to be, in my view, much more modest than America because the inflation issue is nothing like as serious.
Has the bulk of the excesses out of the tech stocks, the very highly valued growth stocks, already been cleaned out?
No, I think so, yeah, because so the classic areas would be like the profitless tech thematic theme, yes, which is maybe down 55, 60%. And the biotech's a fantastic long-term story, but clearly it was very well.
Yeah.
But in a real monetary tightening cycle, these things could be down 85% and still be good long-term stories.
Okay. Well,
whereas the FANG stocks may be down 30% before the end.
Do you think there is a 30% odd decline in the large cap FANG names, as you said?
From top to bottom, I think without a doubt.
Okay, if maybe the Nasdaq is down 27, I guess some of the FANG stocks could.
But this is, but the real issue for this year is: do we have another U-turn by the Fed later in the year? the key issue last year, if you believed inflation was coming back, which I did, the only thing that really mattered in the markets last year was when would the Fed admit it was wrong.
Yep.
So we had to wait till November for that.
Okay.
So this year, the only thing that matters is you have this very hawkish rhetoric, and they're now beginning to act on the rhetoric. But the key issue, longer on a one-year view, is do they switch before the end of this calendar year?
Basically, when does the Fed put re-emerge?
Right. So people in America, the view, I was just in the US, the conventional wisdom in the US is that the Fed put won't re-emerge until the S&P is 30% off its peak.
Okay.
But there's also a political issue, because one reason the Fed did the U-turn last November, in my opinion, was because there became political pressure from Washington, the Democrat Party in Washington, for the Fed to be seen to be doing something about inflation, because the Biden administration is being blamed for the inflation. The opinion polls show that, fairly or unfairly, that's the fact. And they're worried, they became worried because of the November midterm elections. So if those political pressures change and the political pressures go the other way, then you may get a change in Fed tone.
Okay, well, you spoke about the Fed balance sheet tightening as something that was unexpected. You know, I did the math of, the entire maturity curve as well. But first, the balance sheet has expanded by 100% from March 2020 to today. 4.5 trillion has become nearly 9 trillion.
6 to 9.
Okay.
Yeah.
No, that was 6 to 9 if you look at the end of 2020.
Yeah.
If you go to the beginning of 2020, it's doubled in 2 years.
Yeah.
Okay. Now even they're going to take off treasuries 60 billion a month. Let's come to MBS later. Even assuming they take out 1 trillion in 1 year or 1.2, it is still down only 10% from the size. I mean,
That's
you
right.
expand 100% in 2 years, and then you take off only 10% in 1 year. Why should it be such a big deal? And I'm not sure it will even be 10%, because some of them are MBSs, and MBSs are not rolling off on their own. They're rolling off after 15 years.
Yes, but I'll tell you why. It's because it represents uncertainty for the market. You may be right, it may not turn out to be such a big deal, but the fact is we've never had this scale of quantitative tightening before.
Okay.
So, but the balance sheet expansion was enormous, I agree with you, and that's why we had this huge move in the equity markets, and the balance sheet expansion was used primarily to finance fiscal transfer payments.
Yes.
So that's why I call it, it's not pure modern monetary theory, but it's modern monetary theory light. And so the original cause of the inflation we've been seeing in America in the last 6-9 months is the money printing, which happened when the policy response kicked into the pandemic, when M2 growth exploded. Okay. So actually the cause of this inflation is money supply growth, but that has been aggravated by the supply chain bottlenecks.
Chris, are we really saying that we will, after what, 10, 12 years, more than that maybe? We don't remember what a QE-less world looks like, right?
No, my personal opinion is they will not, the political system will not allow a normalization of monetary policy.
Okay.
But but if they really do tighten in the way they're indicating, and they're not deflected by a financial or political fallout, then they can definitely slow the economy and bring inflation under control. And then treasury bonds will become a very interesting investment.
So what is your guess as to when the Fed may turn? I mean, they can't sound anything but hawkish at 8.5 inflation.
No, right now, if you're managing money, you have to go in the short term with a hawkish Fed rhetoric. I would say the best chance you could see a change is in the lead up to the midterm elections. So I would say beginning of fourth quarter.
And the other thing you point out is that there is a bit of a credibility issue as well, right? I mean, they have to do what they're saying that they will do for the Fed.
No, the Fed is, in my opinion, the Fed has lost credibility. Well, for many people, the Fed lost credibility 15 years ago, but for the mainstream conventional wisdom, the Fed lost credibility, which is more important. And yes, so to that extent, because they spent last year talking about transitory inflation. So there were two reasons I believe Mr. Powell did the most dramatic U-turn by a central bank actually I've ever seen. last November. One was if you have, I think it was 7% inflation at that time and your target's 2, if you continue to talk transitory, you risk becoming a self-caricature. But I think that's only 50% of the reason. The other 50% of the reason was the political pressures changed in Washington. Because the moderate side of the Democratic Party definitely became concerned. If you remember that Build Back Better legislation, which was pushed by the progressives, and the moderate part of the Democrat Party became concerned, correctly, they were losing the middle ground, they were looking too extreme, and the inflation was out of control, and Biden administration is being blamed for the inflation, which actually is a little unfair, because the money printing, which really is causing this inflation, happened back in March, April 2020. And we have to remember, for an Indian audience, may not understand this, in the West, households have been massive financial beneficiaries of the pandemic because of these big transfer payments. This has not happened in Asia. People in Asia and India or China have not been paid money to do nothing. But this paying lots of money for people to do nothing has artificially stimulated demand. And by the way, is another reason why you're seeing the participation rate in American employment not coming back as quickly as some people expected, and why companies have to pay up for labor in the US.
Chris, we have to take a break on that note, but we're coming back with lots of India questions for you. Back in a jiffy with Chris Wood.